What's up? Today we'll be talking about two relatively new ETFs from Invesco, Semiconductor ETF SOXQ and Biotechnology ETF IBBQ, also known as IBBQ. These ETFs are very similar in both ticker and composition to long-standing iShares ETFs SOX and IBB. Basically, Invesco went to iShares and said, "Hey, can I copy your homework?" "Sure, but change it up a bit so it doesn't look so obvious." Brilliant marketing move because they will show up when you search for SOX and IBB. In this video, we will talk about the sectors of each respective ETF, the similarities to the iShares ETFs, the differences from the iShares ETFs, does it make sense to switch over, and at the end I'll give my own opinion, because I am the expert on my own opinion. If at any point you decide you like this video and find it helpful, don't forget to hit the like button, because that's what it's there for. Also, feel free to lurk down below and check out the links in the description. You can get free stocks, free crypto, cashback on purchases, and other fun stuff. Without further ado, let's get started. SOX and SOXQ are both semiconductor ETFs. Semiconductors are materials that have an electrical conductivity between conductors, generally metals, and non-conductors or insulators, such as most ceramics. Semiconductors are used primarily in electronic devices, including chips, diodes, transistors, integrated circuits. Anything that's computerized and uses radio waves depends on semiconductors. They have enabled advances in communications, computing, healthcare, military systems, transportation, clean energy, and countless other applications. Without them, there are no smartphones, radios, TVs, computers, video games, or advanced medical diagnostic equipment, and that would be a big bummer. Semiconductor stocks have been some of the most spectacular performers over the last few decades. Bulls would say that the semiconductors are the backbone of the rapidly expanding technological age, and growth outlook is stronger than ever. Bears would say that these stocks are expensive, growth is already priced in, and they have already had their run. IBB and IBBQ are biotechnology ETFs. Biotechnology is technology based on biology. Biotechnology is technology that utilizes biological systems, living organisms, etc. to develop or create different products. It's a very innovative and forward-looking sector, but investing in it can be very high risk, high reward. A breakthrough technology can provide investors with life-changing returns, but with that comes the risk that a company's promised technology may never make it to the market and the stock can tank. I did some more detailed videos on semiconductor ETFs and biotech ETFs that I can link to in the description. So first, let's cover the similarities. While the Invesco ETFs technically track different indices, they are very similar to the iShares ETFs. SOX has 32 holdings, SOXQ has 31 holdings, IBB has 376 holdings, IBBQ has 375 holdings. For SOX and SOXQ, both have roughly 60% in the top 10 names. We see names such as Broadcom, Qualcomm, Intel, Nvidia, AMD, and Taiwan Semis in the top 10 of both, just in slightly different percentages. SOX and SOXQ overlap 87% by weight, with 23 overlapping holdings. For IBB and IBBQ, both have roughly 50% in the top 10 names. We see names such as Amgen, Regeneron, Illumina, Moderna in the top 10 of both. AstraZeneca makes a showing in the top 10 of IBBQ. IBB and IBBQ overlap 77% by weight and have 261 overlapping holdings. SOXQ and IBBQ haven't been around long, but in their short lifespan, they have performed similar to the iShares counterparts. You can see this with the numbers on the screen. Again, they have much overlap by weight, so this isn't a huge surprise. Just try to ignore how ugly the recent performance numbers are for these ETFs. The market has been having an absolute fit recently over rising rates and Fed tapering. Tech and growth stocks are particularly in the crosshairs when this happens. Small caps even more so. Really any risk-on asset sells off. Granted, these ETFs are market cap weighted, so they are mostly large cap, but they do still hold some smaller cap names. Some investors might steer clear during such chaotic times and not try to catch a falling knife. Others might steer into the fire. Like they say, be greedy when others are fearful, be fearful when others are greedy. But I do want to take a second to marvel at the 26% average yearly annual return of SOX over the last 10 years. This is absolutely incredible. This is literally the best performance of any ETF over the last 10 years. It really speaks to the strength and growth of semiconductors over the last 10 years. If you average a 26% return every year for the next 40 years, at the end of the 40 years you will have $238 million. Obviously this would never happen, but a man can dream. And it really illustrates the power of compound interest and why we should aim to save and invest as much as we can, as early as we can. But smash the like button if you'd like to be invited to the party that I'm throwing 40 years from now on my $238 million yacht. Now on to the differences. The biggest difference is cost. SOXQ and IBBQ are the lowest expense ratio ETFs in their respective subsectors. This is a trend I am all for. Some of the older ETFs were a bit more expensive. The newer ETFs are becoming a little bit more competitive on cost to try to gain some market share. And we as the end user are the beneficiary of such competition. SOXQ and IBBQ both charge 19 basis points. This means that on a $10,000 investment, these ETFs would each charge $19 annually. SOX charges 43 basis points and IBB charges 45 basis points. Prior to SOXQ, the cheapest ETF in the semiconductor space was SMH by Van Eck. Prior to IBBQ, the cheapest ETF in the biotech space was XBI by State Street Global Advisors. It may not sound like much of a difference, but small differences in cost can compound into large differences over time. This calculator shows the concept. If you invest $6,000 a year into two ETFs, one with a 19 basis point expense ratio and one with a 35 basis point expense ratio, assuming equal returns of 11% annually, at the end of the 40 years, the 35 basis point ETF would cost $142,000 more. You could buy a Tesla Model S Plaid with those cost savings and still have some money left over. So while neither of these ETFs are cheap compared to the broad market ETFs that only charge 3 or 4 basis points, I think they are fair and competitive for being specialty ETFs. If you believe in the outperformance of these sectors over the coming years, it can certainly be worth the cost difference. By this logic, we don't want to step over dollars to pick up pennies in worrying about these expense ratios. But if you don't believe in the outperformance, then maybe it's better to stick with a cheap broad market ETF. After all, the future performance is unknown. The cost side of the equation is the only thing that we know and can control for certain. Buying a low-cost broad market index fund and holding for the long term is a tried and true method for building wealth, but it can certainly limit upside potential. However, there is one thing that the old iShares ETF have over the new Invesco ETFs, and that is better liquidity and therefore lower spread costs. Spread is the measure of liquidity and the cost of trading shares, essentially the difference between the bid and ask price. If the ETF is popular and trades with robust volume, then bid-ask spreads tend to be narrower. But if the ETF is thinly traded, or if the underlying securities of the fund are highly illiquid, that can also lead to wider spreads. Because the Invesco ETFs are newer than the iShares ETFs, they have fewer assets under management and trade with much less volume. The spread cost of each is as follows: 0.03% for SOX, 0.1% for SOXQ, 0.02% for IBB, and 0.17% for IBBQ. So while a trader frequently moving large amounts of shares may still prefer SOX and IBB for the lower spread costs, a long-term buy and hold investor would likely prefer the cheaper expense ratios of SOXQ and IBBQ. The expense ratio difference will matter more over time. So is it officially time for us buy and hold investors to panic sell our SOX and IBB for SOXQ and IBBQ? Well, not so fast. First, we should consider the tax implications of doing this. For an investor sitting on SOX and IBB gains in a non-taxable account such as an IRA or an HSA, yeah, maybe it is time to make the switch. But for an investor sitting on SOX and IBB gains in a taxable account, well, it might not be worth the tax hit that they would have to take in realizing those gains. But putting future purchases into SOXQ and IBBQ could certainly be something that they could consider. Another thing for the taxable investor to consider: if the market really takes a dump like it is right now, they might find themselves at or below their cost basis in these positions. This could also be the time to make the switch. So what are my thoughts on these new Invesco ETFs? I like them. Cost is often the thing that deters me from buying these specialty ETFs. Invesco has been making moves to lower costs, and I love to see it. Side note, those that hold Invesco QQQ should also check out Invesco QQQM. It's the same ETF but with a 5 basis point cheaper expense ratio. I can link in the description to a video that I did on this in more detail. So while SOXQ and IBBQ are not identical to SOX and IBB, I think they are close enough that it can be justified making the switch in a non-taxable account. We don't know if the Invesco ETFs will slightly outperform the iShares ETF or vice versa, but we do know that they will be cheaper over the long term. So I don't currently own SOX or IBB, but I do own a lot of the semiconductor ETF SMH. I chose SMH over the other semiconductor ETFs because it was the most competitive on cost. Needless to say, SMH and SOX aren't identical, but they do overlap 72% by weight. I like the composition of both ETFs, but because SOXQ is cheaper, I am switching my non-taxable SMH holdings for SOXQ. I am holding my taxable SMH unless there is a drop that would put me at or below my cost difference. All my future semiconductor purchases will go to SOXQ. I think that both semiconductors and biotech have interesting growth potential in the future. I am personally more bullish on semiconductors as I believe that industry has a better risk-reward ratio. What do I know? But if you found any of this helpful, consider hitting the like button to subscribe for more content like this. Again, also consider checking out the links down below. Currently down there you can get 2 free stocks with Webull, potentially valued up to $2,300, $30 of M1 Finance, $50 of Bitcoin with Celsius, where you can earn interest on your crypto holdings, and $30 with Rakuten, where you can get cash back on online purchases. However, these promos do change over time. As always, this is not financial advice, just entertainment purposes only. So thanks, and I'll see you in the next video.